Thanks everyone for joining us today. We're very excited to talk about investing in real estate. We're looking forward to diving into an interactive conversation between David Blain, founder and CEO of BlueSky Wealth Advisors, and Ken Gee, founder and managing member of KRI Partners. Today, David and Ken will talk about when and why BlueSky recommends investing in real estate and KRI's unique approach to multifamily real estate investing. Before we get started, just a few housekeeping items to cover. First, this webinar is being recorded and will be available on demand after the event. The link will be sent to everyone that's here in the next day or so, and it'll be available on our BlueSky website in our resource center. Questions, please use the Q&A feature to submit your questions for David and Ken. We'll get to as many as we can during the event, but if we don't get to it, we will make sure to follow up with you afterwards to make sure that we get you an answer. Otherwise, we are looking forward to a fun time today. So David, I'll hand it off to you and we'll get started.
Okay, great. Thanks a lot, Aisha. Appreciate it. And thank you to everybody for joining today. I see a lot of familiar names and some new ones. So really thrilled today to have a great friend of BlueSky, Ken Gee, here on the webinar with us today. Some of the things I'll be going through for our clients will be old information possibly with I got some new slides in there to share with you. But certainly, so I'll take the first 20 or 30 minutes or so and go over what's happening, real estate from a big picture, like why we recommend, why is BlueSky always talking about this real estate? You know, aren't you a financial advisor? Aren't you supposed to just talk about the stock market? No, we don't think that's a great strategy. And I'll outline why that's certainly an important part of people's financial independence, but real estate we think should take a prominent role as well. So I got a couple of slides here that I'm going to share with everybody. First off, we're going to, I wrote a book. Some of the things I refer to are in my book. If you'd like a free copy, I didn't write it to make money on. For those of you who know anything about writing books, it's really not a way to make money. I wrote it to get some information out there, and I'm going to refer to some charts and some things in the presentation today that are in my book. If you'd like a copy, we're happy to send you one. It's got a lot of good information in there on not just real estate, but about financial independence, achieving financial independence in general. So please feel free to reach out if you can take a picture of that QR code or reach out to us after the webinar. So what we're going to cover today, why real estate, some of the risks, who should invest, talk about some real estate portfolio design. We'll talk about investment vehicles. And then, of course, we'll turn it over to Ken to talk about KRI Partners. So part one, why real estate? This is a chart that's right out of my book. And I put at the top, begin with the end in mind. And so I want you to just kind of mentally take a picture of this. Real estate investing is a continuum. From the left-hand side, you have people that buy and own local property. They take out a mortgage, they buy a property, and they manage it themselves. And then all the way on the right-hand side are what are public REIT mutual funds, where you can buy them with a click of the mouse at Schwab or Vanguard or someplace like that in a brokerage account. And so I'm not going to spend a lot of time on this slide today, but I want you to kind of put that in the back of your mind as I'm walking through this and think about the different ways that you can invest in real estate. And at the end of the presentation, we'll come back to this slide and kind of talk more specific. But I like to put it out there in the beginning so people have kind of a visual that real estate is a continuum investing. There are multiple ways to do it. So why real estate? Here's kind of the summary, 6 main things that we're going to talk about. Number one is it's a large part of the global market. If you believe in investing and investing in different parts of the world, different types of investments, you can't ignore real estate. It's really hard to get the data on all private real estate and public real estate, but you could just see here, sometimes we'll use the REIT market. So that stands for Real Estate Investment Trust, which are large companies that have taken their real estate portfolio and put it into a structure called a REIT that then is traded on a stock exchange. And so this we kind of use as a proxy. We'll talk about why we think there are better ways to invest in a REIT, but still it's a good proxy for the size of the real estate market. And you can see there the past several decades, it's a large part of the market. And so unless you feel like you only need to invest in one type of investment, one source of return, we think that you should add real estate to your portfolio. Here in the US, we've broken it down here looking at the square footage and value estimated by NA REIT and CoStar. This is a couple quarters old, but somewhere in the order of $20 trillion. That's a massive portion of the US economy that we think you should not miss out on. Institutional investors, you can see there 64% of investors in the North America as well as globally invest in real estate. This is one of my favorite slides. If you're not familiar with Tiger 21, Tiger 21 is an exclusive ultra high net worth group of people that pay about $35,000 a year for the privilege of meeting in small groups where they basically tear each other apart over their investment of ideas. No, seriously, it's like a mastermind group for investors. You have to have at least a $20 million liquid net worth to join, but they publish their asset allocation of their members. And so I have up here these ultra high net worth people that have over $20 million of investable assets. This is how they invested ending in Q1 2023. And you can see that full 24% of that is in real estate. This is not their home. This is investment real estate. It's provided competitive returns. So you're like, oh, that's great. You know, all these people are investing in it's this large asset class or whatever, but show me the money. Can I make some money in it? And this is a graphic showing the real estate versus stocks, private real estate, and bonds. And you can see there the graphic at the top, the dark blue one is the NA REIT Global Extended Index, which is an index of REITs. And you can see it's competitive. Now, depending on the time frame you pick, you know, maybe better, maybe worse. You know, private real estate may be better sometimes, maybe worse. But the point is, it is a very competitive return worthy of inclusion in your portfolio. Here's another way of looking at it on a, you know, instead of a graphical, but a chart. And you can see there, especially if you go out to the 10-year returns and beyond, you can see that it provides competitive returns. Now, this is the REIT index. This is not the private index. It's very hard to get return data for private investments because it's just not available. There are some databases that attempt to track the property from seller to seller. So for example, when a building sells from one person to another or one entity to another, they record that information and they track that growth. The problem is if that building doesn't sell for a decade or two, they have no data in between to fill in until that property sells again. So once again, you can see these are all the REIT annual returns since 1972, you know, 11, 12%, with the exception of mortgage type REITs. So very competitive returns. In the REIT subgroups, you can see the different types of investments. And Ken later on is going to talk about the multifamily residential. It's not the highest returning, but what I'm sure he'll talk about is really steady, very inflation protected, very recession proof. But you can see the majority of any type of real estate group has very competitive type returns. This shows the different types. So REITs are in the light blue. If you look back, 2010, 11, 12 were the number returning asset class, 14, 15, and then in 2021. And this compares REITs to stocks, bonds, those type of things. So you can see that it has a fair number of years where it is the number one returning asset class. Not all the time, but certainly enough to warrant inclusion in your portfolio. Okay, so we made the case for it's a big market, it provides competitive returns. But now we start talking about some really key factors that I really like, this is one of them. Real estate provides cash flow and growth. In my opinion, it combines the best of both stocks and bonds into a hybrid model. It provides that periodic distributions that people like from bonds or an annuity or something like that, but it also provides that growth over time, the increase in value of the property that stocks do. And so it's really a great investment that combines both of those features. It provides inflation protection. This is just some data that came from Morningstar based on high inflationary environments, moderate and low inflationary environments, and looking at the rate of return in these time periods, which should be important to everyone today. High inflation. Rental property owners have the ability to raise rents. Now, not if you're locked into a 20-year lease or something like that, but especially when you're talking about residential, but typically not locked into long-term leases, like maybe a franchise is going to lock in some sort of lease. Most real estate leases have inflation riders in the contract that the rent will go up at the CPI every year. A lot of rental agreements are written that way. Not necessarily if you've rented a house, you don't see that a lot in the house, but in the commercial world, it's very common to build that in. So it has an automatic inflation protection into the lease agreements a lot of times. Same thing here, looking at low, moderate, and high inflationary periods, you can see the REITs versus the stock market, very good inflation protection. Provides diversification. When you look at your real estate, and this is comparing it to public markets, but certainly private real estate, it's not going to move the same as the stock market or the bond market. So just because the stock market is going down, your private real estate is not necessarily going down. It kind of moves to similar, I mean, they're all affected by the economy, but stocks, bonds, and real estate are affected slightly different than each other based on what's happening in the economy. Before I get into tax, just one other quick thing on that. The other thing I love about real estate, especially private real estate, like we're talking about today, is generally speaking, the investments are not what we call mark to market. And what does that mean? It means that we don't track the value of the property on a minute by minute basis like the stock market. And so what that does is it gives people less to worry about. You don't worry about it. In reality, the value of that building is going up and down every day. But because we don't report it that way, because nobody really cares, we're not planning on selling it. There's no stock market for real estate where people can just buy and sell your building at any time. You don't have a market quote on a minute by minute, day by day basis. And I think that's a good thing. As Warren Buffett said, he wishes the stock market was only open one day a year for people that needed to buy or sell, because they needed money or something like that. It would create a lot less volatility than there is. And so that's what I like about real estate also. There's no formal, valuation done every day, every minute that causes people to panic as the value of their real estate fluctuates. Okay, now let's talk about some tax advantages. As for those of you that know, here at BlueSky, everything we do has a very deep tax angle to it. We pride ourselves on a lot of tax expertise, tax planning, things like that. Real estate is fabulous when it comes to tax advantages. I'm just going to give you some of the highlights of those today. Obviously, we're not going to turn you into a tax expert today, but suffice to say, there's some massive deductions for investing in real estate. Number one, it's a business. So if you go out and buy your own property or you invest with somebody else, there are regular and ordinary business expenses that are deductible against that rental income. So that the cost, like for example, if you have a job and you commute to that job, you cannot deduct your commuting costs to deduct from the income you made from that job. If you own a rental property, you traveling to that rental property, or if you're a passive investor, the people that are managing it, the travel to that property is a deduction that reduces the taxable income of that property. Number two, capital gains, tax-free growth. When you own a property and it's going up in value, that value that's going up, you don't pay any tax on it until you decide to sell it. And then when you do sell it, it is taxed at the preferable, at least currently and historically, the capital gains rate, which is lower than the ordinary income rate. So you have preferential tax. Also, that tax-free growth is huge. If you own a mutual fund or something that is not tax efficient, you can actually pay capital gains tax on the distributions of that fund on a year-by-year basis. So real estate, very tax advantage. Number three, the depreciation deductions, huge. The depreciation when you buy a building, the cost of that is recouped, at least for a commercial property, over 39 years, 39 years. You get to write off the cost of that property as a non-cash charge. You can also do what's called a cost segregation study. I'm not going to get into that too much today, but it increases the deductions that are available to you as the investor, to the point where, generally speaking, if you do some cost segregation and you do it well, the first several years of owning a property, you may put money in your pocket because it's making money, but you will pay no income tax because of the depreciation. Number four, the 1031 exchange. It is one of the last remaining assets that you can sell and exchange into another property on a tax-free basis. There are some small business niche programs, but for the most part, it is the only major asset class that you can sell. Say you buy a building, let it appreciate for a couple of years, you decide you want to sell it and upgrade to another property, you can roll those proceeds tax-free into another real estate investment. Now, I have to put a caveat on that. Not all private real estate investments allow you to do that. Some do, some don't, depending on the approach of the sponsor, but it is an advantage of real estate that's out there. Number five, there's no self-employment tax on rental income. If you owned a regular business and you earned income, that income is subject to Social Security and Medicare tax. Real estate rental income is not subject to Social Security or Medicare tax. So that saves you about 15.3% over wage or self-employed income. Number six is what I call the tax-free refinance, where you can, if the property appreciates and you don't necessarily want to sell it, you can refinance that property and take cash out tax-free. Now, there are some limits, complicated limits that I want to get into, but generally speaking, you buy a property, it appreciates in value, and you can do a cash out refi after a while and put that money tax-free into your pocket. Number seven, TCJ, that's the Tax Cut and Jobs Act of 2017, that allowed a REIT dividends the 20% Section 199A deduction. So it goes along with number eight. 7 and 8 are related. REIT dividends, the public REITs are allowed this deduction. And then number 8, a private investment, you investing in a property or through a sponsor like KRI, you are allowed to take the Section 199A deduction. Now, there is some limits and some qualifications to do this, but essentially what it says is for businesses, and it includes real estate, as long as it's not a triple net type lease. But generally speaking, most types of real estate are eligible for an immediate 20% deduction off of the income of that real estate. So a very powerful tax advantages to investing in real estate. So you combine all this stuff together, and it's our feeling here at BlueSky and a lot of other people that a dollar made in real estate is much more advantageous. You get to keep a lot more of the money you make from real estate than other types of investments. Certainly a lot more than bond investments, which are taxed at ordinary income. rates. So tax advantage is a big one. Now, it's not all Pollyannish. So we want to talk about some of the risks involved in investing in real estate. Number one is debt. Okay, so over leveraging properties. This is the number one thing that I see that gets people into trouble if they don't understand how leverage works and they get on the wrong side of leverage. And you may have noticed the title for today's webinar was, interest rates are going up. It's a great time to invest in real estate. Why is that? It's because people that didn't know what they were doing over leveraged their properties, and now their interest only loan or their 3-year fixed loan or whatever, they're all starting to reset. And so there's some tremendous bargains out there in the market today that smart people like Ken are salivating over, getting ready to buy these properties. So it's a great time if you're smart and you know what you're doing with debt, with rising interest rates, you can pick up some really good bargains. But this is the number one thing that I see both individual investors as well as sponsors of real estate deals that are not as experienced or don't know what they're doing, they get into trouble with that. Number one thing, look at the debt to equity ratio. Number two, the overall economy. Okay, let's face it, the overall economy does have an impact on real estate. It is all local, okay, but the economy in Florida has been doing well, and that helps the rental properties in Florida, even some of the poorer ones, because the overall economy does have an impact both at the state level, certainly in Florida, the massive impact, but the national economy does have an impact on investing in real estate. So you can't avoid it. It is a risk. It's not, real estate is uncorrelated. It's not completely correlated with stocks and bonds, but it does not mean it's completely immune from what's going on in the larger economy. The next one, mismanagement. This is another big one. It kind of goes back to debt. You get people, especially in times of where it seems like everyone is investing in real estate. You flip on the TV and everyone's selling, seminars on real estate and things like that. Everybody thinks they're a real estate investor. Mismanagement. I see this all the time. They don't know how to manage their costs. They don't know how to manage their debt. They don't know how to manage investing in the property, so they turn around one day and instead of that property appreciating value, there's so much deferred so much deferred maintenance that they've really eroded the value of that property, not increased it. Environmental, there are certain things that we can't control. Maybe COVID, I'm not sure which category it fits into this, global pandemics, but certainly there are things in the environment or the overall economy that affect properties. You can have, we had the storms this week down in Texas again, taking people, certainly in Florida, you've got hurricanes that come through occasionally, right? Yeah, so environmental risks are certainly a risk that's out there. This is another one that gets people all the time, speculative deals. Now, we personally at BlueSky do not recommend speculative deals. I realize they serve a purpose in the larger economy. If someone has to buy that piece of land out in the middle of nowhere and build a shopping center and hope people go, I'm just not investing in it. But this is another area where people get into trouble is they just know for a fact that that exit off the freeway is going to be a great place for a gas station, even though there's no freeway there yet. It's on some governmental, 50-year plan or something. Anyway, it's a risk, speculative deals. I prefer buying things where there's actually people paying money already for the building. This is a big one too for a lot of our business owners. We have a lot of clients that are business owners. Confusing investing with a business. Ken and KRI, he is in the business of real estate. I and our clients and our investors, we are investors. And when you confuse being an investor with a business, that's where people get into trouble. Is if you are an investor, there's a certain way that you want to approach that investment as opposed to if you're a business owner and you have control over it, it's a different thing. And so understanding, like if you have a full-time job, you're an engineer at Google, or, you own another business, trying to run a business of real estate, I'm telling you, it turns out very poorly a lot of times. And so I encourage people, be an investor and don't confuse it with running a business. It's a lot of work to do it really well. It is a lot of work. Okay, so we're going to wrap up here kind of with who should invest. Look, it's all there's a lot of factors here, but generally speaking, we like to see people, you have to be an accredited investor, first of all. You have to have certain income thresholds and net worth thresholds, but we like to see you should have at least 500K liquid in a non-retirement account. Okay, that's our criteria. It's not a hard and fast rule, but that's what we like to see, because what that means is you have some sort of core plan in place. If you're just starting out in a job, and maybe you are a credit investor, you're out of high school out of college, and you got a job at Google, and you're making $800,000 a year. I'm sorry, I would not recommend putting your first investment be a bunch of money into real estate. Someone has to understand the risks. Someone that doesn't understand what I just went over the risks, we would not recommend do this. I would also suggest having a team to help you. Tax, a finance person, if you need one. If you don't, that's fine, but certainly a tax, if you're not comfortable reading legal documents, you're going to be given a lot of legal documents. You'd have somebody on your team that knows what they're doing if you're just starting out. And then if you're buying it yourself, just making sure that you don't get in trouble with debt. One quick comment on real estate and IRAs. There's nothing wrong with using an IRA to invest. We typically don't use it because your IRA is already tax efficient, and your cash flow is somewhat restricted. But you can use it. There's a lot of tricks and trades to it. If you do want to do it with your IRA, please get somebody that knows what they're doing. There's a lot of these real estate groups out there that encourage people to use their 401ks, IRAs, or whatever to invest in real estate to the client's demise. They don't follow the rules correctly, or they're just not suited. So just beware with that. It's not something we typically recommend. It can be appropriate for some people, but please make sure you get some advice on that. What percentage to invest? Once again, it comes down to each individual person. The ancient Talmud said, put a third of your money in paper assets, a third in real estate, and a third in a business. That's a pretty good starting point. If you're going to do less than 5%, don't bother. Really, less than 10% of your investable, it's almost like you won't even notice the difference. So generally, most of our clients are going to fall between 10 and 25, or a 30% of a third of their investable net worth. We recommend diversifying by strategy, type, location, vehicle. For properties, we typically stick with the value add or possibly some core. We kind of stay away from the opportunistic, recognizing there are different types of ways to invest in real estate and understand what you're doing. Obviously, we're here talking with Ken today, but if you're listening or you're going to other webinars, understand where they fit in this. If they're investing in raw land, understand that is completely different than what Ken is proposing here. The same thing, if they're investing in some steel and glass Class A property in downtown Manhattan, that's completely different than what we're going to be talking about today. So understand, and we recommend diversifying by different property types. We love the multifamily that Ken does. We don't put all the money in multifamily. We don't put it all in one state. We think Florida multifamily is a great place to be, and we put a chunk of money in it, but we recommend looking at other types of investments as well. I already said location. Don't get hung up. A lot of people, I see this, especially if you're buying your own real estate, while you may know that market better, man, there's a whole world out there. And there's great opportunities in different places around the country. Okay, so getting into the investment vehicles, we're going to go back to this chart here. We're going to get through this quickly. On the left-hand side, owning and managing local property, you can see there below that, most experience required, most hassle, least diversification, least liquidity, but you have the most control. Yes, you do. You have more tax benefits, and you have the fewest layer of fees. So there's some advantages to doing that. And I know there's actually some friends of mine on this call today that are really good at it. Like they own a lot of property and they're really good at it and they make a lot of money, I assume. That's a legitimate strategy, but this goes back to don't confuse being an investor with owning a business. So over on the right-hand side, we have your REITs, real estate investment trust. You're going to get, oh, I skipped that. On the left-hand side, higher possible returns. I fully acknowledge that. If you are some real estate guru and you know your individual market like nobody else, oh, and by the way, you're also a realtor, or one of my favorites, I had a friend that he was a title insurance attorney, and he knew every property that was getting ready to go bankrupt, and he would buy them before they went bankrupt. Made a tremendous amount of money buying properties directly from the owners before they went through bankruptcy. Not sure how ethical that was. I don't know. Oh, we won't get into that. But anyway, so higher possible returns on the left-hand side. On the right-hand side, you're going to get average returns. If you're in a REIT mutual fund, great. I still think it's a good REITs are acceptable investment, but you're going to get average returns. You don't need any experience. There's no hassle. Most liquidity. You click a mouse button, you can buy and sell, but you have the least control. You have the least tax benefits. You have the most layer of fees, and it's not on here, but you also have the most volatility. You got the ups and downs of the market. And so in summary, we like the middle bucket here. And it'll be called all different things. I call it syndicated properties, but it's basically where you work with an experienced operator like Ken or some other sponsor that does this full time. This is their job. This is what they do. And you are a limited partner in some sort of vehicle where you're not liable for the debt. You're not liable for the management. And there's professional management in place. That is where we feel you get that higher returns are available, but not a lot of hassle. And it's the line where you're not responsible for any of the debt, which is what I like. A couple things. The last slide here, we'll talk about what makes a good partner. Number one, looking at experience of management, the fees and transparency, the size. And you may think opposite way. If they get too big, they're not going to be able to capture that value add. They're going to be operating in a more competitive area of the market. So we like not like micro teeny, but not these giant multi-gazillion dollar funds. You want to look at their deal structure and flow. This is really important, how they treat their investors. I can tell you the partners we work with and people like Ken, they treat the investors like gold, and that is one of the most important things to do. And then my little sort of personal vendetta against Wall Street, make sure they aren't headquartered on Wall Street. And if they happen to be on Wall Street, make sure it's not sold by a broker. If it is, there are some decent ones, but you got to be careful what you're getting sold by that. So with that, actually, I'm going to postpone the questions. We'll postpone those to the end. So without further ado, I'm going to turn this over to the founder and managing partner of KRI, Mr. Ken Gee.
Thank you very much, David. Wow, that was super informative. Heavy on the data, which I usually don't do, but man, I know that some of the folks that are in our funds and in our investments, I really, really appreciate what you just did. So thank you very much. And I do have to say that we have thoroughly enjoyed the relationship that we've had with you and your team. And, you know, the more I hear you talk, the more I understand why we're just, I feel like we're just a great fit. So thank you again for co-hosting this with us. So I'll just give you a very brief background on myself, just so many of you don't know who I am. I'm the managing member here at KRI. I started this company a long, long time ago. Let me back up even further. I grew up in Toledo, Ohio, got my undergrad from the University of Toledo, moved to Cleveland, got my master's degree from Case Western Reserve. While I was getting my master's degree, I spent 5 years as a commercial lender. And some of this is going to be relevant. You'll understand in a minute. At that point, then I decided, you know what? I got my master's degree. I want to go be a CPA. Not sure why I wanted to do that at the time, but I did. I went to work for Deloitte for 7 years as a CPA. Got to do, whatever fun work you can do as a CPA. I was on the tax side, got to do merger and acquisition work, did a lot of really cool stuff with some really good private equity firms, just learned an enormous amount. But it was there that I realized that I did everything I was supposed to do, but I forgot one thing. I didn't know how I was going to spend time with my family. Because if you know anything about CPAs, we are working 95,000 hours a week. And I came to the realization that my family was going to grow up without me. And I said, I'm not having that. So I started the process of figuring this real estate thing out. And, 19 deals later, we'll go over that in a minute, but 19 deals later, here we are. And, we've done really, really well. And I don't have any regret over that decision to leave Deloitte. Deloitte is a wonderful place to work. Trust me, as CPA firms go, they are one of the best. But it was really nice to be able to come out here and do what we do for other people. So I'm going to share my screen now to talk a little bit about what we do, what our current fund is. And David covered all of the reasons you would want to invest in real estate. I mean, he did just a fantastic job. So I'm not going to spend any time on that. I'm going to talk about our current fund, which is Fund 4. And I'm going to distribute this. I'm not going to read the disclosure to you here, but you will get this. You will get these, the slide deck after the presentation as well. All right. So I want to talk about what's happening in the market right now. The title of this webinar is Interest Rates Are High. It's time to buy real estate. And I just want to dive into that a little bit more because it's what's really going on in the market. So everybody knows that interest rates have gone up massively in the last couple of years. Well, what David said is absolutely accurate. We got people doing a couple of things. One, a lot of inexperienced people came into the market and they didn't understand how to manage that interest rate risk. They thought, okay, I'm going to match up my business plan to my debt maturity perfectly and nothing will go wrong and everything will be great. Problem is, one thing went wrong. Interest rates went sky high on them. So they ended up holding the property longer than they needed to. And what happens when you're not protected, your interest rate goes up, your interest expense goes up considerably, like a lot, and they no longer can afford the property. That's what really is going on out there. The other type of seller right now are a lot of builders. The lead time to get a property like the one that you're looking at in the background off the ground, it takes 2 or 3 years to get this rolling, to get it all approved and entitled and planned and constructed. And it's really hard for builders to really look that far out. Well, nobody thought rates were going to do what they did. So this particular deal happens to be the last deal that we did. A number of David's clients are in it, I'm sure. But this property was built by a wonderful builder. They did a great job. Problem is their interest rate got away from them. We're talking more north of 8%, which is insane to try to handle a property of this size. So what's happening is that interest rate increase is causing them to have to sell. Because we put debt on it. We put 7-year debt on it. You notice we're much less risk averse because of my background. That just makes me manage this debt very carefully. But our rate on this deal was like 5.68, completely different than 8, makes the deal work. Now you would ask yourself, well, why didn't the builder just do that? That's a great question. What happens though is builders know how to build. They don't know how to operate. I know how to operate. I don't know how to build, right? So it has to, that's generally what happens. And there's lots of other reasons why that happens, but that in this particular deal is really important to know. Now, at the same time that the rates are going up, the volatility in the interest rates are going up as well. I mean, it's not uncommon right now to see rates move. In fact, they're on the march up again today. It's not uncommon to see rates within a 10-day period to move 50, 60 basis points. So that's over 0.5%. Well, if you think about a $20 or $30 million loan, that has a huge impact on your interest expense. So lenders have a problem with that, right? They get stressed because they know that borrowers are tight. They increase their coverage requirements, right? They force you to have more income than you would have before because they're more concerned about the risk. So we have rates that went up. We have the credit markets that have tightened. And now we have property owners who have to sell. And this creates not a distressed property. Does that property look distressed? No way is that property distressed. When we bought it, I think it had 2 vacant. It's a brand new property. It is in incredible shape. But the seller was distressed, right? And that's what's going on in the market right now. So so these people, notice this is not a low quality asset, right? This is not the person who bought a value add. The thing was really run down and they're trying to renovate it and sell it. That is happening in the market as well. That just is a little too opportunistic for us. We do value add, but we don't do that kind of value add, right? So what happens when you're in my chair and you're in my shoes doing what we do, it's the life cycle of a real estate operator. He usually starts off with that opportunistic stuff, and then slowly the asset quality moves up because you can, right? The bigger you get, the larger the properties you can afford. But more importantly, you start to change your mindset a little bit to this quick. You're not in this business to make money. You're in it to create wealth. And there's a huge difference there. And that's exactly where we're at. We're in that transition period. I'll talk a little bit more about that. So what's happening right now is strong buyers are now getting really, really good deals. Weaker buyers. Now, what is a weaker buyer? So let's talk about that. Most people, and David uses the word syndication in a generic sense, but a true syndication means that the person like me goes out and finds the deal. They lock it down with some of their own money. They get it under contract, and then they literally have 45 or 60 days to raise the money and then close on the deal. Well, here's the problem. When interest rates move on them in that 45 to 60 day period, it can affect them in a really, really big way. And a lot of times those syndicators who try to go under contract and still need to raise the money, sellers know that that's a risk that they don't want to take on right now. They just don't, because so many syndicators are backing out of deals because they can't raise the money, or they realize that the rates moved and now they're trying to retrade the seller, right? It's just a dangerous situation for sellers right now to enter into contract with syndicators. Now, I'm not dissing syndicators because we have syndicated and I'm sure we will again, but it is a very challenging way to buy, especially when you're in a market like Florida where everybody wants to be, right? Every syndicator has to find a way to differentiate him or herself. They usually do it with price, and sometimes sellers will take that chance. Most of the time, the sellers end up regretting that. So we flipped that process around. We did this a few years ago. This comes from my Deloitte private equity experience. Now you can see why I shared that with you. Private equity firms flip that whole process around. We go raise the money and then use that money to go negotiate better deals, incredible deals, actually. It actually came out of necessity a long time ago because we were syndicators and Mr. Broker, please give us a deal. I promise we'll raise the money. I promise you'll raise the money. Well, Mr. Broker knows what he's doing. Well, you're going to have to pay up. I'll give you the deal, but you got to pay up more, and you got to pay up more. And so that doesn't mean that it hurt us, but it did hurt our overall returns, right? So many years ago, I said, wait a minute, I don't want to keep paying up to differentiate myself from the other syndicators. So we flipped this process around. It worked on Fund 1. It worked on Fund 2. It's working incredibly well right now, because that deal that you're looking at, the only reason we got that deal is because we had the money raised. That's the only reason, and the brokers were crystal clear about that. So we now can buy when many or most cannot. So now so think about, we always follow the cycle, right? You have to be nimble enough to adjust to where you're at in the real estate cycle right now. And think back to the 2008 crisis. That crisis was primarily created, well, there's a lot of reasons it was there, but one of the big factors there was the credit markets seized up on everybody, and they couldn't refinance. Now, they're not seized up right now, but they're absolutely tighter than they were, and interest rates have gone up considerably. So we have a very similar issue. So when debt is the problem, remember, real estate's capital intensive, and your capital stack is mostly debt usually. So if debt is the problem, well, then you go buy and minimize the use of debt, because then you take that problem off the table. And that's exactly what we're doing with Fund 4. And so the intent here is that we buy at a relatively low leverage. I'll talk about exactly what that means in a minute. That is not an issue. It's not going to impact our ability to close, but we're going to use some leverage. And then at some point, when we raise the income of the property, and David talked about that, there is a direct relationship between a property's ability to generate cash flow and the likelihood that someone will pay me more for it in the future. If I can move cash flow, it stands to reason that in the future, somebody's going to pay me more because that cash flow is worth something, right? So as we add value to the property, because we've done our homework and we know that the rents are below market on this deal, if you know anything about builders, builders have to fill the property as fast as they can. They do that with discounts and concessions. So we take over the property knowing in year one that we're going to have a little abnormally high turnover, but every time we turn a unit, it's going to be at market rents, right? We don't have to fill the whole building all at once like they did. So we're going to have some value add there. Very, very important for you to know. And at some point, rates will likely come down, right? So if we get if we just get the value add, we'll likely be able to, in 2 to 3 years, refinance that, add a supplemental loan to the capital stack, and return most, if not all, of the investor's money, and you still own the deal. That's the real wealth creator. Because David talked about refinancing, pulling that money out. It's not a taxable event at the time you do it. Now you go take that money and you go invest it in another asset, and you keep doing the same thing over and over. You just create massive wealth. So let's talk about our Fund 4. Our target returns have not changed one bit. We still target mid-teens annual rate of return. So we project out 5 years, because when you get beyond that, it's really not really useful because you don't know what's going to happen that far out. Over a 5-year period, if you gave us $100,000 on the way in, is our goal to return to you $180,000 to $200,000, right? That comes out to about 15% annual. My goal is to beat that, but that's what we underwrite to. And we don't underwrite lower cap rates on our exit cap rates. We don't underwrite interest rates going down. We assume rates are not going to go down. We assume insurance is not going to go down, but going to go up. We assume all of those worst case scenarios, right? To try to make sure that we target 15 and we hope to beat that. Now, part of that 15% is your cash on cash return that David talked about. So we distribute quarterly. And so our target is 6% annual over the life of the fund. So the fund, our goal here is to put 2 assets in the fund to get a little bit of diversification, right? Remember, we're using low leveragers. We expect Fund 4 to close somewhere between 15 and 20 million. Our last fund closed at 15 million. I like that size because it's not unwieldy. It's easy to function. It's easy to manage. There's not 5,000 investors in it. It just makes sense. It's a good, David, I almost interrupted and used the word Goldilocks size, right? But that's kind of the way I feel about that. It doesn't make the fund so big that it's hard to manage. So in the early years, if we were to get a deal tomorrow, in year one might be 5%. But the idea here is over the life of the fund, it's going to throw off a 6% cash on cash return. These return parameters are nothing different than what we've done in the past, and David will tell you that. So a little bit about this deal. David, you talked about that refinance thing. This deal is a little 90-unit deal in Winter Haven, Florida, right? Not exactly the Mecca of Florida. We agree, it's a tiny little town. But this is what happens when you buy the right asset in the right place. We bought this asset in 2016. We raised $2.2 million to buy it. We have since returned the $2.2 million to all the investors. We've returned another $1.8 million to the investors. They still have roughly $5 million of equity in the deal, and the deal continues to cash flow. That is an example where you see on the screen here, our asset target hold period is 4 to 6 years. We're on year number 8 there. And I can tell you that if I sold that today, I think our investors would hang me, right? Because you can't, when you get, one of our investors this morning called it the golden goose, right? When you find the golden goose, you just keep running with it. So we have refinanced this property, gotten everybody their money back. They don't have a current tax situation. And this is the important part now. This is about responsible management. It's a 2001 asset. It's 23 years old. It's going to need some updating. We have $600,000 sitting in the bank as we update the units to make sure that it remains competitive. And that's really, really important stuff. So our target asset size, no different. This one's only a 90-unit property, but we're looking for 100 to 200 units. That's, again, that's the perfect size for us. A, B class assets, we don't like C and D classes. That's not that we haven't done them. We have. They're tough, right? I know how to do it, but it's you know, what's important to me is if David were to be in town and his family, and he wanted to show them an investment that he made with us, I don't ever want him to be embarrassed to drive by the property. That's really, really important to me, right? All right, I talked about leverage before. Initial leverage, less plus or minus 40%, right? That's really low leverage, right? And normally you wouldn't do that in real estate. But remember, I said right now debt is the problem. So adjust, right? Adjust to, I always say, take what the defense is giving you. The defense is giving you tough debt, so don't rely on debt. Use it sparingly. And then in 2 plus or minus years, I don't know exactly when it's going to be, but we can either sell it, or if we refinance it, the goal here is to get you 75 to 80% of your money back. Similar to what we did at Arbors at Garden Grove. The first tranche, well, I think after a year and a half, we got people 70% of their money back. And they did wait a little bit longer for the rest. But what's important is you still own the asset, you're still getting cash flow, and that's the really important thing. So I don't think David spent much time on this, but you know, I try to make sure we're not here for fees. I didn't put the fees on this slide, but I'll talk about it. Our fees are, David, you'll be thrilled to know we even lower our fees more, right? Our asset management fee was 1.5%. It's down to 1%. We do a 1% acquisition, 1% disposition. If you look at all the syndicators and sponsors, I think you'll find that some of the lowest fees out there. We have also given ourselves the ability in Fund 4 to waive permanently or defer some of our fees if we need to, so that we can make sure that we're getting you what you expect in terms of your cash flow. Again, I'm not here for I mean, cash flow is very important to me, right? If you get cash flow, I get cash flow. But what's more important to me is I know this long-term appreciation is where the real money is. It's where the real wealth building is. And if I have to take a little haircut on a fee or something for a year, that really doesn't matter to me, right? I would much rather, you know, you don't want to be penny wise and pound foolish in this business. So it's called a waterfall in our world. Basically, what happens if we sell the property or refinance it, you get your money back for the whole fund. So let's say you committed $100,000 to the whole fund. We have to return that entire $100,000. Then it's an 80-20 split after that. It's that simple. I try not to make this any more complicated than it needs to be. Now, in the smaller cash flow distributions that occur quarterly, those are in a straight 80-20 split. So again, trying to keep these waterfalls. This is an example. If you talk to a lot of syndicators, you'll see some have multi-tier waterfalls and it gets all complicated. And I end up spending 25 minutes just trying to explain to people what it means. And the reality of it is, it is almost insignificant. So I prefer to have simple splits like this. So this is a deal, it's mostly blacked out, but this is a deal we did in Tallahassee in Fund 1. I just tried, what I'm trying to do is give you a feel for what kind of deals we buy and what kind of assets that we buy. We've been in the business for about 27 years. I said we've acquired 19 properties. Our senior management teams managed more than 16,000 apartment units in Cleveland, in Ohio, PA, and Florida. So we've been there, done that for sure. We definitely know how to execute. I think that's an important part of why we're successful, because sometimes when you use third-party managers, there's a lot of things that can go wrong there. It's hard for me to find third-party managers that have 25 plus years experience, right? You learn a lot in 25 years in this business. And I am proud to tell you, the last point here, we have never lost a dime of investor money, even back in 2008. And I am super proud of that. To give you an example of what our Goldilocks size looks like, this number is a little higher now. It's over 43 million, but we have raised from more than 300 investors, more than $43 million so far. We've distributed almost $26 million so far. So the point in telling you that is, you know, you have to have a pretty good infrastructure in place to deal with that level of capital and that many investors. And I think David would know, his clients would let him know if we weren't taking good care of his clients. So that is really it on my presentation. I will tell you, the last time debt markets tightened, I've talked to, I was going through a personal divorce back when it happened the last time. I couldn't buy then. Boy, was I sorry. I was sorry for the divorce, of course, but I was even more sorry that we couldn't buy then, because the people that bought in 2011, 2012, they just made insane amounts of money. It is not that extreme right now, but I believe we're in a very similar situation because the credit markets are so tight. I would not, I would encourage you to not miss this opportunity to do this. So with that, David, I will be happy to entertain questions from you or anybody in the group.
Yeah, thank you, Ken. That was great. Really informative, and I'm looking forward to Fund 4. It's a beautiful, beautiful property there in St. Pete, and I know there's others out there as well. So we did get a couple questions that I think one was about IRAs. I'll deal with that, but the second one I thought was interesting is how the question was how they can secure the risk that you as the sponsor, and you're right, thank you for, unfortunately my book was printed several years ago with the syndicated properties in the middle. So thank you for explaining the technical difference between syndicator and a fund like yourself. But anyway, so how to secure the risk that the fund sponsor or manager or whoever is running the thing will not go bankrupt or run away.
Yeah. So those are two completely different issues. So first of all, so let's say we go buy property A. Property A goes into an LLC, and the fund is a partner in that LLC, right? So all of the partners in that fund own part of that LLC, which owns the property. So if I go bankrupt, it has no effect on this partnership. I'm just a bankrupt sponsor. That's all I am. That doesn't mean that the property is bankrupt. Right? I can't go in and just take money out of this property. I mean, that's a crime. There's no way I can do that. So I wouldn't worry about the sponsor going bankrupt. Now, what if I do run away? The reality of it is I have a team somewhere close to 50 people on the ground. If I ran away, or let's say I got ran over by a truck, let's do something that might be realistic, right? We will appoint. So I used to handle this differently, right? I used to leave it up to the fund to select its own replacement for me, but I don't do that anymore. I don't do that because as I continued to think through that process, it didn't make sense to me. I set the fund up for a potential, no, I want to be in control. No, I want to be in control. And you don't want that situation. That doesn't work. So we will appoint a replacement Ken, basically, who is the managing member. The managing member continues to exist. The fund continues to exist. The property continues to exist. Remember, there's a loan on the property. Everything continues. And all that has to happen is it's a key person. We call it a key person in the legal docs. That's what it's called. So we just appoint a different key person. And there are numerous choices. I mean, we're very, very deep in our markets. In fact, I didn't mention this, but many of the brokers that we buy and sell from also have invested in our funds. So we know everybody in this market, and they will absolutely make sure that they select the right person to be the new Ken. That's a really good question. I appreciate that.
Yeah. Yeah, we've got a lot of questions coming in. I know Ken and we talked about this before. We are happy to stay here and answer all these questions. So please stay on the call, but it is 3 o'clock and I'm a, very time sensitive person. So we said it was gonna be an hour. So I'd like to, for those of you that have to go or whatever, thank you so much for attending. Please reach out to myself, Ken, if you have questions about real estate in general, me, about the fund in particular, and you're a client of ours, come to us and we'll take care of you, or write to Ken. But thank you for joining us. And like I said, we're happy to stay on, and I'm going to get to all the questions that are coming in here now. Okay. So I'm going to take one. We had a question coming in about the self-directed IRAs. And I think I always get a little bit of flack for this. Those of you that know me know that I'm I always have an opinion, and I'm not afraid to share it with people, and that is one of them. That my experience with this has been most people that are investing their self-directed, that their IRA into these type of things is because they don't have any other money. And so they, by my definition, they should not use their IRA or 401k money to do this if they don't have any other money. If they have $1 million IRA and that's all the money that they have saved, we just cannot in good conscience recommend that people do that. You are allowed to, there's nothing wrong with it. We believe that there's a better approach to building wealth than having no liquidity at all and taking your retirement account and putting it into real estate, especially because it's so tax advantaged. You're putting a tax advantaged vehicle into a tax advantage wrapper. It's completely unnecessary. We'd rather see you build some other money to put into the tax advantaged real estate and keep the money in a tax advantaged retirement account. So just to be clear, it's not that there's anything wrong with it, but we think there are better ways to do it, number one. And number two is not the people we work with, but there are a lot of sponsors out there that frankly get people with not a lot of money to invest their life savings and their IRAs into real estate deals. And I don't see it work out really well for a lot of people. Now, if you got a $10 million net worth and you've got a $3 million IRA, great, fine. Let's talk about that. But if you're worth, 1,100,000, you just clear the accredited investor thing, and 999,000 of it is in your IRA, we're not going to recommend that you do that. So enough said on that. A couple quick questions for you, Ken. I will do some easy ones. Closing date for the fund?
Yep, that's a great question. So the way our funds work, they're closed-end funds. So we are now in the process of raising that capital so that we go to the broker market. So we have about $5 million to deploy in our last fund. We are currently raising for Fund 4. I think we're between 3 and 4 million already. It's only been open for about 2 weeks. So we're about 3 or 4 million in soft commitments right now. So our goal right now is to raise as much as we can, as fast as we can, because, and I saw somebody else has a question here, do I already have assets? There are assets coming on the market like crazy right now. And the reason they are is because everybody was hoping and praying that Mr. Powell would lower interest rates so that they could sell their properties for more value. It has become crystal clear to them now that that's not going to happen very soon. So they have been hoping and praying that that savior was going to come and rates were going to go down. They're not. They now know they're not. So they have this debt problem that they can no longer ignore, and they have to sell. So the reason I'm out pounding my hand on the table about this opportunity is this isn't going to last that long. Right. There are a lot of guys with a lot of money chasing these deals. Well, I'm sorry. There are some people with a lot of money chasing these deals, and those who get these deals right now are going to make an enormous amount of money. That's what I believe. I can't guarantee that, and I'm sure everybody knows that. So now let's talk about the fund. What happens is I raise money, and the moment I go under contract for that first deal, that fund closes. And there's a very important reason I do that. A lot of funds allow new money to come into the fund on an ongoing basis. That's an open-end fund. I don't do that for a couple of reasons. Number one, it is impossible, I think, to do a Bernie Madoff type Ponzi scheme when you have a closed-end fund, because there's no new money coming into the fund to fund investment, distributions to the old one, right? I'm not planning on doing a Ponzi scheme, but why even put yourself in that situation, right? It's not possible to do it. The other reason is that if I have an open-end fund and David and I are in the deal, well, in order for us to allow a new person in, we each get diluted. And nobody wants to be diluted in this business. So I close the fund. That's it. We've raised what we've raised. And if we have leftover money, we'll combine it with Fund 5. Raise another fund and go do that, right? Because I don't ever want to have a situation where we sold, the fund's closed, and David knows I made money or I didn't make money. I mean, it doesn't keep going and going and going like some of the funds do. So I answered 2 questions there. That's when the fund will close. As soon as I find that first deal, I will tell you, I've got about a dozen deals in the pipeline right now, and there are some really good ones. There's a really nice build to rent. There's a really nice property in the Tampa area. There's a number of them that are now there. They have to sell, and there's not enough buyers to go around right now. I will tell you that. So I'm in a race here to raise as much capital as we can, as fast as we can, so that we can all benefit from it.
Great, thank you. It's I mean, I know the answer to this question, but it's your fund, so I'll let you answer. But it's only residential properties, and it's all in Florida. Correct?
We do multifamily. Right now we're in Florida. I'm looking at other markets, but one of the challenges with me is I'm extremely risk averse. I'm extremely slow and deliberate. So we're looking at Charlotte. We're looking at a couple of other locations, but it's not going to happen anytime. I'm not there yet, right? I'm not comfortable. I don't know the markets well enough yet, but we are so deeply entrenched in Florida that the deals, what happens to us is we'll underwrite a deal. They'll ask some ridiculous amount of money. Maybe $29 million. We say, nope, can't do that, but we're here and we can close. 3 months later, we get the call. Is there any chance you'd go for 25 or 24 or 23? This really goes on. And what I want to do is be ready for that. So that's what happens when you're deeply entrenched in a market. You get those phone calls because those brokers, they only make money when a deal closes, and they need to know that we can close. And so that's what happens.
Okay. I'm going to combine a couple, like there's actually some questions coming in on the chat, regular chat and the questions. So I think a couple of questions about financing. Let's take that. So what concerns do you have about credit markets, potential stress on regional banks that do the bulk of these financing?
Yeah, so regional banks aren't doing the bulk of our financing. Most of the stuff we're using right now is agency debt, Fannie or Freddie, and so it's securitized and sold off. So is it possible that the regional banks probably have more exposure to the smaller multifamily and probably more to the office and small retail than they do the stuff that we buy. So most of the stuff that we buy is not affected by that. Am I concerned about it? Yeah. Do I think any depositor will lose money? Remember, I don't have a crystal ball here, and David is probably far more qualified to answer this question than me. But I've not seen the FDIC allow anyone to lose a dime of depositor money, and it doesn't seem like that's going to happen. So when banks fail, well, who's going to lose? The equity holder. They'll lose, but I don't think the depositors are going to get hurt. So it will hurt the credit markets in terms if the asset that you're trying to finance is reliant on that banking system, but we're generally not. I mean, we're agency debt right now is the best place to go.
Yeah. Without getting too far in the weeds, ever since the Federal Reserve System has been set up, and really since 2008, no depositors lose any money. I mean, with Silicon Valley Bank, the news wasn't even out yet that they were having trouble before the Federal Reserve was handing out money to everybody that looked like they might be concerned. I mean, we've crossed that Rubicon so far. It just they're not. They may let some minor equity holders get wiped out, but they're not going to let that happen. Okay, have you ever missed a quarterly distribution?
Yeah, in 2008 I did on a property we did in Cleveland. Notice we don't do anything in Cleveland anymore. There's a reason for that. No, I like Cleveland. I live in Cleveland, but it's not exactly a growth town. But we did make up those distributions before we sold the property. And we did skip, let me correct that one more time. We did skip 1 quarter distribution right after the pandemic started. I think every single syndicator on planet Earth did the same thing, then realized, oh, we're okay. And we paid it back the very next quarter. Because in our world, what's important in the real estate world is that we don't lose the asset, right? It's coming back around. Just don't do something stupid and lose the asset. So it just made sense. We didn't know if people were going to pay their rents. There were a lot of laws that seemed to be stacked against us during that time. The reality of it is, if you buy the right assets in good diversified areas, in good areas, we had 2 or 3 people that might play the game, but most people don't. Most people want to pay their bills. Most people did pay their bills, and they needed their apartment now more than ever. So we actually were a focus. I mean, we absolutely, raised our service level because they were now home 24/7.
Yeah, yeah. Let's jump over to the web chat here. We got a good question about any concerns about hurricanes and flooding in Florida?
Yeah, that's a great question. So we're careful about what we buy. So I wouldn't buy something that was 40 years old on the coast, stick frame construction, right? I wouldn't do that, right? Because there's a lot of risk there. But having said that, our hurricane risk is insured, our flood risk is insured, all those risks are insured. So that's really important to know, number one. And number two, we help to mitigate that. For example, that Arbors at Garden Grove, it's in Winter Haven. That is a frame constructed building, and it's gone through several hurricanes. And the worst thing that happened was we lost some siding, right? So if you're going to be near the coast, you've really got to be strong. Levi is in St. Pete. It's not too far off the coast. I mean, it's not right on the coast, but the current codes for constructing a building now like that are much higher than they were in the 1970s and 80s. So we manage that risk by being careful about what we buy and the way it's constructed and all of that. And then the insurance industry keeps us honest because they just do, right? If it's a high risk, you're going to pay an enormous amount for insurance.
Right. Yeah, and a corollary to that question, in the individual market, we've had actually clients in Florida that have lost their coverage. The insurer no longer writes, and they're forced into the state pool or whatever it is.
Citizen. Yeah.
And so you have not had any issues continuing to cover your property.
No, and in fact, I am thrilled to report that I've been doing this a really long time. The insurance market does this. When it's at its peak, right? When rates are at the peak, you're thinking, man, I'm never gonna get relief, but it always cycles on you. So what happens is right now for Levi, we budgeted $2,330 some per unit per year for insurance. Think that's $250,000 a year for insurance. Well, we budgeted for annual increases. What's actually happening now is rates are coming down. Because what happens is when you're writing at that level, that's massively profitable for the insurers. And we're in a capitalist society, so it attracts more capacity into the market because it's massively profitable. And then the downside starts to help. So that is exactly what's happening now. And I'm thrilled because, we didn't underwrite that, but I'll take it, right? That's wind to your back.
Yeah. I think a follow-up here, well, if you raise more money, you're gonna have more than one property in the fund.
That's the goal. Yeah, Fund 2 will have probably 2 assets in it. So the Levi is in Fund 2, and it still has another $5 million that we'll add to, right? So Fund 2 and Fund 4 will likely be partners in the next deal. And Fund 4 will have some extra money, and we'll just keep doing the same thing so that we can always have a place for investors to go, right? Remember, I close every fund when we close our first deal, and it gives us an opportunity to continue to get new deals. That was one of the things that hurt me in Fund 2. I didn't have that flexibility that I do now.
And I think, especially for our clients on the call, is understanding there is a bazillion ways to structure these things, and each one has a little bit different approach based on their comfort level, their way they want to do it. And so while it's called Fund 4, as Ken just described, it's a little bit different than some of the other groups that have a fund with capital calls and a more of an open-ended structure that are aiming to put 25 or 30 properties into the fund. I think that's a fair statement, Ken, that you're not looking
It
to
is.
put 25 or
No,
30.
no. I like the $15 to $20 million size. If I can get 2 to 3 assets in each fund, that makes me happy because that brings closure, right? That gives people a way out. They're not stuck in that fund forever.
Right. And another corollary to that, which I thought was a great explanation. What happened to Fund 3?
Oh, yeah, that's a great question. I get it every time too. So you're going to laugh. So, according to the rules, my grown daughter, who's 25 years old and does not live at home, unless I quote unquote hire her and make her part of my organization, which would not be the real. I mean, that would be a farce. She can't invest in our deals. So I said, all right, I'll do a friends and family fund. Well, as it turns out, many of our employees wanted to also invest. So it's a friends and family fund. It's not a fund that I could even, it's closed, right? It's done. It's one of the little partners in Levi. It doesn't have much money, but my daughter's $5,000 is in there and a couple other people's 10 or 15. See, absent that, I can't talk about it publicly because you're not allowed to solicit money in what's called a 506B fund. It is truly a friends and family fund. So that's fund 3, and that's how we got from 2 to 4. That is a very good question. I get it every time too.
Is there a minimum investment for 4?
Yeah, 100,000. But here's what's important. I say that, but look, I don't want to encourage small investments. I can't go solo. But here's what's really important. I don't need your last dollar. I don't want your last dollar. I want you to invest at whatever level you're comfortable with, especially if you haven't experienced us before. I have the ability to waive that. It is more important to me that you not regret making too large of an investment. And so if you put maybe 75 in fund 4 and you like how it's going, well, then put more in fund 5. That is more important to me than having you put 150 in fund 4 and now thinking, man, I wish I wouldn't have put so much in, right? I don't want that situation because life is way too short for that.
Yeah. 1031. I talked about it on the presentation, but these are not 1031 funds. So maybe you could explain.
Yeah.
Yeah.
Yeah, let me talk through that. So there is a technical way that I could do a 1031 with a fund. I'd have to distribute the asset out to all the partners. Everybody would have to be on the deed. And then when I sell, every single person has to agree on the price and sign off on the deed. And you could imagine the legal fees, right? So you can do it. You have to create what's called a tenant in common and whatever. That is not reasonable. It's not really doable, right? It's not practical because the legal fees to do that alone would eat you alive, let alone getting every single partner to agree to sell for exactly the same dollar amount. They just wouldn't. So you can't do the 1031 in our fund. You can't. But here's what we do. So you talked about the cost segregation study. I think that's really important. We do cost segregation studies on our funds. And so most likely anybody that invests from this call is probably passive. So they probably can't take the depreciation deductions against other income, but instead they carry it forward. So now fast forward, we sell that asset. They get to offset some of the gain with some of the losses that they've been holding on to and waiting for the gain. They're going to pay capital gains tax, which is a considerably lower rate than the ordinary income rate. And hopefully they've had a good experience and they want to reinvest with us in the next asset that we do another cost segregation study. You see, so we try to do the best we can to kick that tax can down the road. I know taxes are important to people. I would just encourage people, please be careful with 1031s. Brokers love 1031 buyers because they know they're buying with a gun to their head. They are on a time frame, they cannot deviate, and brokers will absolutely take advantage of that. And so just be careful with 1031s because I've seen so many people, I call it using the tax, allowing the tax tail to wag the dog, right? That's the whole CPA thing. I'm not saying to not pay, I'm not saying you should pay taxes. I'm just saying be careful because I've seen a lot of people make bad deals coming off of really good deals and they lost all the money that they made because they were so focused on the taxes that they would just pay whatever the broker would force them to pay just to not pay the tax. So just be careful with those 1031s. That's all.
Yeah. So you and within the fund, you are not planning to do any exchanging of like any selling or buying of the fund, doing 1031s within the fund itself either.
No, because everything passes through, number one. And number two, it is like recycling equity. And so I could, if I did that, I would basically be holding your capital hostage if I just kept recycling it and recycling it. And I just don't think that's fair, right? If we sell the property, I want you to get the money and I want you to be in a position to decide what to do with that money. If you want to reinvest it again, or if you want to take your money and go home, I want you to have that choice. That's important to me. So we don't recycle equity. And that's why some firms do. There's nothing wrong with it. It's just a decision that I've made because I really try to stay investor focused, right? I don't want investors in a fund that, you know, their life has changed and, hey, I need out. Okay, well, when the fund sells the asset, or maybe even I'll buy them out if I can, because I'm always happy to put more money in my own deals. I want to make sure that the solution is focused on them. That's why
it's important for investors too, and to have an actual plan for like what is the plan, and understanding, hey, this particular real estate investment is going to liquidate in 4 to 6, 7 years, whatever. This one, there's going to be opportunity at 1031, so that either you're not getting capital back that you didn't expect and have to pay the tax on it, or alternatively, that you're not looking for the capital to spend on your kid's college or something, and it's being perpetually 1031. And I think that's where the planning is involved. And it's also, frankly, not only diversification. In my presentation, where I talk about diversification of sponsor, is, you know, granted, Ken's different. Ken owns the company. If he wants to put all his money in his own company, that's one thing. But as a fiduciary to a client, we would never recommend that you put all your money into one particular type of investment. It's better to have a diversity of different type of properties and sort of distribution philosophies. Okay, let's keep going here.
Can I answer Jay's question? What's the status of Fund 2? So Jay's last question on the Q&A. Jay, Fund 2 has some capital yet to be called. It's roughly $4.5, $5 million. I don't remember the exact amount, but that money will, as soon as we find that deal, that money gets called first. And then whatever else I need will come from Fund 4. That's how it's going to work. And so it's all I'm going to do is keep rolling these funds from fund to fund to fund, so that I can try to get 2 to 3 deals inside each fund.
Right.
That's a very good question.
Somebody asked about the tax benefits. Do you get the 8 tax benefits in the fund that I outlined? And the answer is no, you get 7. As Ken just described, he's not going to do the 1031, but yes, they may not be as direct to you, but they all apply to the fund structure. Ken's getting deductions for the management and the staff and everything. That's a deduction for you as a part owner of the building. Capital gains treatment, you get the depreciation as he talked about, no self-employment tax. You can do the tax-free cash out, as he just explained, on that property in Winter Park. And then you do get the Section 199A, possibly. Okay, possibly. The rules are very complicated, and so especially in the initial years, if you have a loss on the property, you're not going to get the 199A deduction. But if that property does flip to an actual income or gain, then you will see the benefit of 199A. So the short answer is yes. The long answer is there's some nuances to the 8 factors.
I think the most important tax benefit there, though, David, is you're getting these cash flow distributions. Unlike if you owned a stock and you got a dividend, you're going to pay tax on that, right? Most of the time. That doesn't happen in our situation. It's just going to be a reduction of your capital. And so that is the most important benefit, right? Because people are not paying tax when I send out those distributions. They're getting 100% of that money to use.
You get As long as we're asking, so the fund issues a K1,
Mhm.
and on that K1, box 2 is rental real estate income, which in the first couple of years of the fund is going to be probably negative.
Mhm.
Not freak out as some people do. That's expected. Hopefully, we've
Yeah.
talked about this a little bit, but still, when they get that form, like that box 2 is negative. But then if you go down to, I think it's box 19A,
Yeah.
distribution, it's usually a positive number. And that's the money that you put in your pocket. Box 2 is the amount that you pay income tax on, which is usually negative, especially in the first several years. So that's really the main benefit. It's the cash flow is very tax advantaged, which brings us to this question. A little confusing. I think I understand what the person's asking, but they say if a property is refinanced and there was a 6% annual return prior to refinancing, how will the return be calculated?
Yeah. So yeah,
Thing,
oh, go ahead. Sorry, David.
say the first thing, Ken, I think you should clear up is the 6% annual return. People get very confused on that. What exactly is it, and what is guaranteed and what is not guaranteed, and what
Yeah.
time frame is that guaranteed? People get
Yeah.
really
Yeah, let's talk about guarantee. So unfortunately, there's no guarantees. There are none. This is a business that we're running, and I can't guarantee you're going to get 6%. I hope, I target, right? That's my goal, and I'm doing everything I can to make sure that you get it. Now, let's just break down the dollar amounts. There's no easy way to do it. If you put in $100,000, then my goal would be to distribute $1,500 to you in January, April, July, and October. That's the goal. That's 6%. Now, let's fast forward and let's say, well, I refinance the property and you got your whole $100,000 back. Well, now there's no 6% on capital because you have no capital left in the deal. You got it all back. Well, so you might think, oh, so now I'm not getting any cash flow distributions. See, we wouldn't do that because remember, let me just talk about in a real estate deal, there's two main partners. One is the lender, one is the equity person. The lender's about 6%. I'm rounding here, okay, just to keep it simple. And the equity people want about 6%. So as long as the property throws off 6%, everybody's happy. Well, now the property's still throwing off 6%. The equity guys have no more in it, but the lender's only 65% of the deal. That means 35% of the deal is still generating 6% cash that is still going to go out to you. That's exactly what is happening at Arbors at Garden Grove. They continue, and that particular deal was a long time ago. So they were at 8%. They're continuing to get the same dollar amount that they would have gotten had they still had their capital in the deal. They're pretty happy about that, of course, but there's no capital left. So what happens is your return becomes infinite because you've gotten all your money back. And now we distribute as much as we possibly can. I couldn't imagine a scenario where I would refinance. I don't think the lender wouldn't even let me do that. Refinance to the point where there was no cash left for you intentionally. That is not something we would ever do. So what you want to do is take that, in my example, take that 100 grand and go and invest it in another deal and earn 6% on that 100 grand. While you're still earning what was 6%, you're still earning roughly the same amount. See, and now you're just starting to stack those cash flow distributions because you're recycling the equity yourself. You've made that decision though to go into deal number 2 and deal number 3.
And this is what I've talked about with people. This is how you build wealth. Okay, it's not the first year. It's not fund 4. Okay, it's compounding the cash flow on your capital such that my cash on cash return at this point after investing for all these years is way into the double digits. Like I don't even know what it is. It's free money. Okay, it's free money. It just keeps coming in.
Mm-hmm.
And it's not on the first deal. Like it's 6 for people like, oh, well, I can get 5% on a treasury bond. Yeah, that's not the point. The point is when you get all your capital back and there's still money flowing in from the investment, that's building wealth because you've got all your money and you're getting free money because you still own the property, even though you've got all your capital back. That's how you build wealth with Ken. Other groups, it's the 1031 is you're taking that 100,000, the property doubled in price, and instead of you taking the 100 and going to another deal, they take the 100 and buy a $200,000 property. So you still have the same amount of capital invested, but you have double the property throwing off 6%. So now you're getting 6% on 200,000. It's the same principle, just different approaches. But after several years of doing this, 5, 10, 15 years, you've gone through a cycle or two of real estate, is you end up with not a lot of capital of your original capital invested, but cash flow coming in. That's how you build wealth.
And not to mention, you own assets. Here's the really important thing. We talk about inflation, and I do this every now and then in some of our webinars. If you look at what happens, your dollar is still worth $1.20. Or no, a dollar is $1 today or 20 years from now. The problem is today's dollar and 20 years ago dollar, they are completely different. The purchasing power is massively different. Whereas that dollar that you invested in that real estate, guess what? As long as the cash flow is increasing, right? The operating income of the property, the asset itself is appreciating. So that dollar that you put into real estate doesn't lose purchasing power. It's gaining purchasing power at least, right? As long as you made a good real estate investment. And that's why I don't hold any cash. I put as much cash as I can in real estate, because over time it's going to continue to keep up with inflation. And that, we're talking a lot about cash flow, and it's very, very important. But remember, I talked about the overall return. My target overall return is 15%. Only 6% of that is from cash flow from operations. There's an enormous amount of appreciation there that is massive wealth development. Because in the case of Arbors at Garden Grove, those guys got all their money back. They almost got it again, and they have $5 million in equity. That's just crazy money. That's an enormous amount of money. It's that appreciation that allows the lender to lend on it so that you can get your money out and go do another deal. And that's why wealthy people do real estate. That's why they love hard assets. Because how many stocks? I'm sure there are some, but the S&P doesn't pay out a 6% dividend, does it?
No, it's about 2%.
Yeah.
And if you hit it right, it is. I believe in having a little bit of each.
Agreed. 100%. Yep.
But when you add in the tax advantages of real estate, it's hard to beat. Hard to beat. For the one of the first slides I showed is the cash flow and the growth is the S&P 500 has returned 14% annually since 2009. Okay, but there's not a lot of cash flow. It's the dividend yield hovers between 1.5%, maybe 2%. Not a lot of cash flow. So it's great. You got this giant portfolio. You got to sell something to fund a goal. Where with real estate, if you can build up a capital base, the cash flow will fund everything, and you can just keep compounding the capital and not touch it. So that's what I like about the cash flow that gets thrown off. It's not required. Some deals will have no cash flow, but I prefer the ones that have the appreciation. And I think the 15% is a good target, a good kicker at the end if you do decide to sell the property. But if you don't, if it's the golden goose, keep owning it.
Keep your hand out.
All right. I think I'm losing my voice. So Asia or Ken or somebody, if you can see the questions.
Yeah, let me take a look here. Amazing webinar. Thank you, Jan, for the very kind words. If we invest in a fund, do you have okay, yep, we already answered that. Any trouble with insurance coverage retain? Yeah, I think we talked about that, Madeline. Yeah. UBTI, I think yes, we report the necessary information. We do have some investors that use self-directed IRAs, and we report all the necessary information that you need for UBTI. I won't get into a deep discussion on that, but
yeah, it's that's what I said. If you're going to do it, make sure you have someone that knows what they're doing advising you on that.
Mm-hmm. Are there any concerns about investment properties in Florida? Okay, we talked about that. I'm going up in the chat. I think we're pretty good there, David.
We got all the ones in the chat.
Yeah, I think there's one, just quick question about the commitment. Is it a single full investment or are you doing
Yeah.
capital calls?
Yeah, that's a really good question. So in Fund 2, we did capital calls. And so in Fund 2, there's still capital to be called. I've done a few funds. Never had this happen before, but we had 8 people flake when I did my capital call in Fund 2, which I covered. It's fine. It is what it is. But because of that, remember, everything we do is for a reason. And so you can't have 8 investors flake on a $15 million deal. You just can't. If it's the wrong investors, it's really hard to cover. So now what we do is we collect the money at the time you subscribe. We put it in a PNC bank account where I can't touch it. It earns, right now, PNC is 475, and that interest goes right back to the investors. I take none of it. I don't want any of it, but I have to have the money there because when I go hard on a deal, I have to close, right? We don't have a choice because then it costs me an enormous amount of money if we fail. So I wanted to explain to you why we changed that, and that's why. And I'm trying to do it as equitably as I can, but you can't, when you're in my chair and you make a commitment to a broker, you cannot not close. It's just not an option. So, Sean, let's see here. I'm not a plant. Okay, let's see. Ken is a comment. Oh, great. Thank you. I've been getting my cash flow every quarter.
Oh, I'm not a plant. I get a plant.
Yeah. We don't want, he didn't want anybody to think he was a plant in the audience.
Yeah. Oh, thank you for
I
that.
will reinvest every day. Oh, thank you.
Yeah.
Thank you, Sean. Wow, thank you.
It's just Sean from California. He's saying Ken's accomplished everything he said he would. Been getting cash flow every quarter, and he'll reinvest every dime. Keep it up, Ken. And we at BlueSky would echo that as well. Yeah.
Thank you.
There's the question about the investor, like the sponsor going bankrupt and all that kind of stuff. I mean, look, that's a due diligence thing, and you got to know who you're investing with. They need to have a track record. I put it in my slides. What are you looking for? Like, look from somebody that's from Cleveland, not from downtown. Sorry,
David, I have 4 rules I want people to follow, and I've watched a lot of people fail. Make sure your sponsor has experience, not because it's obvious, but because we didn't know hyperinflation was coming. We didn't know COVID was coming. You need a management team that can figure out how to navigate business. Number 2, they need to have a good track record, and not just a track record of buying properties. You want to know that they've taken them full cycle. That's really important. And number 3, transparency. They need to be transparent with you. It's why we paid a company called Veravest to vet our entire track record. It was not a fun experience, trust me, but it was really important so that when people like you or David wants to know what our track record is, they know that somebody has looked under the hood. And the last thing is you want to make sure that the sponsor is always putting investors first. So when I see things not go well with a sponsor, usually at least 1 or 2 of those rules were broken. I can't give you a perfect scenario, right? That is a foolproof test, but those 4 rules, if you follow them, you're really stacking the odds in your favor.
Yeah. All right. Well, look, we have exhausted all the questions. If you think of something later, feel free to email me, or I'm going to speak on Ken's behalf. I know he'll be happy to answer your questions as well. Absolutely. I know I've enjoyed it. Ken, we need to do this more often or in person. Love to get together sometime. But any of you, we can do anything for you. Please let us know. But I'm looking forward to Fund 4. It's going to be a great time to invest in Florida. So thank you again to everybody for joining us.
And David, let me say one thing, and that is, we have watched you guys operate for many years now. And every single time I talk to an investor, you guys just nail it. I mean, I love what you do. I love why you do it. I love how you do it. You're a true fiduciary. You're looking out for them. Just to be fully clear, in case anybody thinks there is no payment between us and him, none whatsoever. That would be inappropriate based on what I know about David and his firm. And so in the world of wealth managers, that's not always true. I don't know the wealth management space that well, but I know to find a true fee-based manager is really, really critical. because the best advice you can get is from somebody who isn't trying to sell you something. So I did want to acknowledge that, David, because that is one of the reasons that we really enjoy this relationship.
Yeah. Thanks a lot, Ken.
You bet.
All right.
All
Enjoy
right.
the rest of your day, everybody.
And if you like the content that we've shared here, please be sure to subscribe to our channel and hit the bell. So thank you again and have a wonderful day.